Our session is on dividend policy, which is a specific aspect of the capital structure decision. We cover 5 main topics: choice of payout policy, types of payout, how dividends are determined in practice, payout controversy, which begins with the theoretical proposition that dividends are irrelevant to firm value, then moves to conditions wherein dividends can decrease firm value, and conditions wherein dividends can increase firm value. We close with the implications of taxes for the firm's dividend policy. Firms have a choice of dividend, or more broadly, cash payout policy. In making the choice, it's important to note that a dividend or other cash payout is a capital structure decision, because a dividend payment takes equity as well as cash out of the firm. Hence, a dividend payout increases the percentage of assets financed by debt. The criterion for the payout decision is the effect of the payout on the value of the firm to its owners. We need to ask the question, does a dividend payment increase or decrease the value of the firm to its owners? There are several types of payouts to owners that a firm can use. Perhaps the most common is the cash dividend, where the firm pays cash to its shareholders. Firms can pay a regular cash dividend, which occurs regularly, such as quarterly, or they can make a special cash dividend payment. They might do so if they have extra cash at the end of a year, for example. When firms make a cash dividend payment, the market value of equity, or the share price, declines proportionally to the amount of the cash dividend. A second type of payout is a stock dividend or stock split. Here the firm issues additional shares to shareholders. In general, stock dividends and stock splits, or share issues, have no effect on the market value of equity. But the share price declines proportionally to the number of shares issued. A third type of payout is a stock repurchase, wherein the firm buys back stock from the shareholders. When it does so, the stock that it buys back is held in the firm's treasury, and that stock is referred to as treasury shares. There are several means by which a firm can purchase stock from its shareholders. It can buy shares of stock on the market, on the secondary stock market. It can have a tender offer to its shareholders to buy stock at a particular price. It can hold a Dutch auction. The firm offers to purchase shares from its owners at an initial offer price. The price is then lowered until the target number of shares are sold back. Finally, the firm can have a private negotiation with a large shareholder or shareholders, wherein a price is agreed upon and the stock repurchase is effected. In a stock repurchase, the market value of outstanding equity declines as shares of stock are taken out of the hands of its owners and put into the treasury. However, because of the increase in the demand for the firm's stock in the stock market, a stock repurchase can increase share price and thereby firm value. Here's the distribution of types of payout over the past 20+ years by U.S. corporations. The top of each bar indicates total earnings. The red portion indicates cash dividends. The blue portion shows stock repurchase, and the maize portion shows retained earnings. Cash dividends, as a percentage of earnings, have declined in the most recent period in favor of stock repurchases, which have become almost as common a means of paying out cash to shareholders as cash dividends. Before getting into normative dividend payout theories, or theories about how much a firm ought to pay out in dividends, let's look at the results of research presented in the BMA text on how managers approach the dividend decision in practice. This research was conducted by John Lintner using a structured interview approach with corporate managers. He was able to develop several broad conclusions. First, firms have longer-term target dividend payout ratios rather than short-term, year-to-year targets. Second, managers focus more on dividend changes than on absolute levels. Second, managers focus more on dividend changes than on absolute dividend levels. Third, dividend changes follow shifts in long-run sustainable levels of earnings rather than short-run changes in earnings. Fourth, managers are reluctant to make dividend changes that might have to be reversed. And fifth, firms repurchase stock when they have accumulated a large amount of unwanted cash or wish to change their capital structure by replacing equity with debt. Now let's approach the dividend decision from a normative perspective. What should the firm's dividend policy be? We start with the theoretical proposition that dividend policy is irrelevant. This proposition rests on the existence of perfect capital markets, or markets with no transactions costs, no taxes, good information, and no other market imperfections. Under these conditions, investors can convert shares to cash and vice versa without paying taxes or transactions costs. Since investors do not need dividends to convert shares to cash, they will not be willing to pay higher prices for firms with higher dividend payouts. Because investors can convert shares to cash if they need cash and the firm pays no dividends, or investors can get rid of cash they don't need or want if the firm does pay dividends, dividend policy may have no impact on the value of the firm. While perfect capital markets imply the irrelevance of dividends, the existence of market imperfections can mean that dividends affect firm value. Dividends can increase value if there are costs associated with the transaction of buying and selling stock. The notion here is that there are natural clients for high dividend payout stocks. These clients want cash flow and they want to avoid the transactions costs associated with selling shares to get cash. So they increase the price of the stock through their demand for a dividend-paying stock. In the absence of perfect information, dividends are sometimes viewed as providing signals or information to the market about the firm's growth prospects. Dividend increases send good news about cash flows and earnings, and dividend cuts send bad news. Because a high dividend payout policy will be costly to firms that do not have cash flow to support it, Dividend increases signal a company's good fortune and its managers' confidence in the future cash flows. The presence of taxes as an important market imperfection can mean that dividends decrease firm value. Companies can convert dividends into capital gains by reducing dividend payout. If dividends are taxed more heavily than capital gains, tax-paying investors should welcome such a move and value the firm more favorably. In such a tax environment, the total cash flow retained by the firm and/or held by shareholders will be higher than if dividends are paid out and taxed. As a general rule, if capital gains are taxed at a lower rate than dividend income, which has typically been the case in, let's say, the last 100 years in our country, companies should pay the lowest dividend possible. Dividend policy should adjust to changes in the tax code. So in recent years, we've actually had a change in the tax code, which has resulted in a lowering of the tax on dividend payment, so that the tax on dividends is now not very much higher than the tax on capital gains. This reduction in the dividend tax rate has likely stimulated higher dividend payout than would have been the case in the absence of that tax reduction. Here's a public policy controversy. In the U.S., shareholders are taxed twice. Notice in the table here, let's say the firm has operating income of $100. Further, let's say that the firm has a corporate tax rate of 35%. So the firm pays $35 in corporate taxes, leaving an after-tax income of $65 that could be paid out as a dividend to the shareholders. Now, if the shareholders have a 15% tax rate on dividends, which is the case now in terms of tax law, they will pay $9.75 on their dividend payment, leaving a total cash to the shareholder of $55.25. So the argument made on one side of this policy debate is that shareholders are taxed twice, first because their firm is taxed, reducing the potential dividend payout, and second, because their dividends are taxed as well. This dual taxation of shareholders is viewed as incompatible with the tax treatment of earned income, which is taxed once, and even the tax treatment associated with other forms of firm ownership, such as partnerships and sole proprietorships, which again are also only taxed once. The counter-argument is that corporations are separate entities from their owners. As such, corporations and their owners are afforded special advantages and protections not available to either individuals or other types of firms. Hence, it is not inappropriate to tax corporations separate from their owners.